Hello, everybody, and a warm welcome to this month's Horizon Live event from Wood Mackenzie. This is a monthly series of thought leadership sessions where we like to grill our analysts on their latest insights, and we invite you to do the same by asking our Horizon authors anything on the topic. My name is Gavin Thompson. I'm the Vice Chair for Europe, Middle East and Africa at Wood Mac, and I'll be hosting this session. And I'm delighted to be joined by two of my colleagues, Tom Ellacott, Senior Vice President, and Greg Aitken, Research Director from our corporate team. And today we're going to be discussing, debating, potentially disagreeing on our outlook for the future of upstream oil and gas investment as we take a deeper dive into our latest horizon, the cost of capital discipline, big oil's next decade longevity challenge. The plan for today is not to go through the horizon in depth, which you can read at any point on woodmac.com/horizons, but rather to see where the conversation takes us as we consider how sustaining hydrocarbon production through the 2030s has become a strategic priority for many of the world's largest oil and gas companies. A topic which, of course, we have to now view through the prism of conflict in the Middle East and what this might mean for future investment, for supply, demand, and prices. I think there's going to be a lot to discuss. But we also want to hear from you with perhaps alternative views that challenge our analysis in this horizon. And before we start, I'd like to touch on a few housekeeping items. First of all, your microphone will be muted during this webinar, but you can send us questions at any time using the Q&A panel on the screen. And these questions are confidential. They can only be seen by our presenters. And we'll try to answer as many of these questions as possible throughout the webinar. So please fire away. Please also note that content is for the purpose of the webinar and not to be used in any other publications. So on to the debate. Tom, I want to start with you. It's obviously important, I think, from the outset to note that the research which has gone into this horizon was done before the outbreak of war in the Middle East. So it will be useful, obviously, to throughout the conversation to put the findings into the context, not only of the immediate disruption to supply and price volatility, but also the longer term impact. So what was the rationale behind the decision to do this research?
Sure, yeah, thanks, Gavin. Good afternoon, everyone. Yeah, I mean, it really sort of stemmed from conversations with our clients that probably started about a year ago. And probably a sort of reflection of some of the Euro majors dialing back some of their low carbon ambitions and starting to repivot towards the upstream sector. And a lot of our clients were asking us, well, sort of what does the outlook look like over the next decade in the oil and gas sector? You know, this is still the cash engine for oil and gas companies. And with the slowing transition, there's more pressure to sustain that. So we were having a lot of conversations with our clients, and we thought it would be quite timely to, first of all, look out over the next 15 years at the oil and gas production growth profile for 30 of the world's largest companies. We excluded the big resource holding NOCs in the Middle East in the analysis, but also to do a look back over what we were forecasting back in 2015 and to compare the two forecasts. And then we concluded with some thoughts on how oil and gas companies can address this longevity challenge.
So I obviously want to ask you what the key findings are from this, but you know, this was published a few weeks ago. Yeah. So much has changed. So maybe, you know, what are the key findings from the research, and has that changed, or do we look at it in a different way given the the context within which we're speaking today?
Yeah, so okay, sort of in terms of the key findings, so as I said, we focused on 30 of the world's largest oil and gas companies. They produce about 50 million barrels a day, sort of 30-odd% of oil and gas demand. But in order for them to sustain their market share out to 2040, they need to find another 22 million barrels a day over and above what we forecast in our base case. Now, that base case includes assets that we regard as commercial. So these are fields that are producing, under development, or likely to receive development approval in the next 5 years or so. And there's always been sort of, you project longer term, there's always a bit of a decline because you don't have full visibility on projects. But what is interesting is if you look back to the outlook in 2015, that gap has got a lot bigger. So in 2015, I think we were forecasting a drop of 11 million barrels a day between 2015 and 2030. Fast forward to where we are now, out to 2040, and that drop is sort of 19 million barrels a day. So the gap that these companies, the production gap that these companies have to replace, has got a lot bigger than what we were seeing back in 2015.
And is that, you know, the title of the Horizon sort of answers my question. You know, is that been because of that focus on capital discipline, which has been pretty ruthless, and shareholder distributions and so forth? Has it also been a part of the story of the longevity of oil and gas demand as we look forward?
Yeah, I mean, I think there's a number of factors at play, and sort of, Greg, feel free to chip in here. But you know, capital discipline. Oil and gas companies, I think, have found a business model that has hit the mark with investors in that they're distributing a lot more of their operating cash flow back to investors in the form of dividends, and any surplus cash flow in the form of buybacks. So that sort of, if you like, is placing a little bit of an artificial ceiling on what oil and gas companies can allocate to investment. So if you sort of go back to the early mid-2010s, some of these players were outspending their operating cash flow. Now, on average, they would be maybe reinvesting 50-55% of their operating cash flow. So that's one factor. I think as well, there were a number of players that had big plans in the low carbon space. You know, to the extent that some of the leaders, the Euro majors, were projecting that by 2030, 50% of their overall budget would be allocated to low carbon. And they've had to recalibrate because of the slowing energy transition and this recognition that they can't move ahead of societal progress. So that was sort of probably viewed as being an important or a very material cash engine next decade, low carbon. And with this recalibration, they're having to sort of lean more into the oil and gas business.
Now, one thing we can't avoid is, you know, does this current crisis change that? Now, I can think of several ways in which it may do. One of them would be around a rethinking of dependency on oil and gas. We've been here before in 2022, and actually beyond the initial shock, we kind of doubled down, if you like, on oil and gas. And you've already talked about low carbon. I mean, is some of the demand outlook, you know, the numbers which you've been quoting, are they at risk if governments steer back towards that sort of more aggressive decarbonisation pathway which we were on up to, I guess, about 2021?
Yeah, I mean, I think it's just too early to say. It's clearly a very volatile environment. But what I would say, sort of maybe from a strategic perspective, I think sort of what we're seeing at the moment, it sort of underscores the importance of having a very resilient portfolio. We're clearly sort of, it's a very, very volatile environment, as it was back in 2020, 2021 with the global pandemic. And I think there was sort of a lot of lessons learned back in the global pandemic about this sort of requirement to build resilience into portfolios. So that means having a strong balance sheet. It means having a very economic portfolio, but also importantly, diversity plays a really key role. And that might mean diversity in upstream, but it could also mean cross-sectorial diversity. And I think sort of those players that may be building positions in the low carbon space, you know, they have got optionality to adjust their capital allocation in the future, depending on how the energy transition plays out.
Greg, I want to come to you. We in the horizon, you talk a lot about the different options that the 30 companies which you cover have to renew portfolios. And I think it's fair to say that the Middle East is identified as a key battleground for business development. But where does that sit right now, given the situation that we're all facing?
Yeah, I mean, I think as Tom said, it is early to say at the moment. We don't know if this is going to be a protracted conflict or if it's going to finish soon and get back to some level of normality. We don't know what Iran's going to look like after this either. But it certainly adds to the risk. To come back to the question you asked Tom as well, I think it's a fair question to ask. How do you get investors to support companies to invest into the long term when there are so many risk factors? This is just shown to be another one, that at the moment an incident has happened, that or an event has happened, and we don't know whether that's going to be a long-term positive for oil and gas or negative for oil and gas, if you like, in terms of demand. We don't know what that's going to mean for the region as a whole. There's just so many unknowns. We don't know how it's going to impact gas versus oil. And so, again, it just funnels back to this dilemma that we've had. I think one of the reasons that investors were pushing, particularly in the US, I think one of the reasons that US investors were pushing US companies to cut down on their leverage and to distribute capital and to reinvest less is because that's the sort of way they viewed the energy transition, if you like. So rather than sort of wanting companies to move into different spaces, what they wanted to do was take some of the risk out of the future and get some of the capital out now, because we don't know, because there is that uncertainty. So again, if you add in just highlight more risk factors, as we've seen, highlight how fragile the industry is, and how things that we thought were going to go one way have gone another way, it just exacerbates the problem, I think.
And yes, I completely get that some of these long-term uncertainties just got more uncertain. One of the short-term issues which this has thrown up has been higher prices. Now, higher prices were not something which companies were sort of baking into their revenue and their forecasts for this year. We're expecting softer prices. So it does raise a question that does see a potential windfall from surging, if volatile, prices. What does that mean for capital allocation? Can companies use this to spend their way out of the portfolio renewal challenge?
I mean, it feels unlikely, I would say. Tom, I mean, obviously you chip in here, but I would say that most likely if you've got a windfall, particularly given the uncertainty of the longevity of that windfall and the fact that oil prices, began with a 5 actually at the start of this year and were $60 before this happened, I think it's more likely to a combination of paying down debt and going into buybacks, sort of one-off distributions back to shareholders would be the sort of first place this would go to, I would think. Again, that's assuming that these prices are sort of temporary, and we get back to a more normal situation within a few weeks or months. If this persists, then we're into a different environment and people have different views on the future. And that comes back to your point earlier about, what does that then do to demand for oil and gas long term as well?
Yeah, I'd agree. And I think coming into this year, the sort of music was very cautious. Companies had sort of taken quite a cautious stance with respect to investment in 2026, sort of saw a number of downside risks on the near-term horizon. I think where it is interesting, Gav, is if there is some surplus cash coming in, for those more highly leveraged players, it will accelerate that deleveraging process. So going back to the point we were making at the beginning of the conversation about resilience, having a strong balance sheet is a really critical component there. So that's sort of one one area I think that some companies will prioritize. But what we've seen is a lot of companies have already been through that great phase of deleveraging and have got their balance sheets in very good shape. So, I think it's really going to be initially, certainly, that surplus cash for those players will be allocated to buybacks. And that's sort of interesting from the cash flow perspective as well, because you're reducing your shares outstanding, which sort of ultimately reduces the cash dividend payment.
Right.
Yeah, I mean, just on that, I guess there are these second order effects, really. If companies do get their balance sheets into a better position because of the windfall here, that probably does make them more able to go out and do something in the future. For smaller companies as well, it maybe makes them better targets for some of these larger 30 companies to go and acquire as well, if they've managed to sort out some problems that they have. It might make smaller companies be able to go out and do, say, extra exploration or extra developments or something like that, which then brings them into the target view of these bigger companies over the medium term, say. So there are, knock-on effects that could happen.
Yeah, and I do want to come back and talk about some of those options. But looking beyond the current uncertainty, what I want to ask you both about is what strategies these companies have for addressing and ultimately solving their longevity challenge, and some of these will be operational, some of them will be structural, but I'd love to hear your thoughts on that.
Yeah, well, first of all, I think what we're starting to see is some companies becoming more creative with their business development. This is an area that Greg spends a lot of time looking at on our M&A team. But for instance, we're seeing more players deploy what we call strategic ventures. So this could be, for instance, Aker BP or Vår Energy would be two examples there. And that's sort of really helping reinvigorate parts of the portfolio that have been sort of previously struggling to attract capital. And Greg, you sort of have you're having a lot of conversations with our clients around this, aren't you? It's quite a hot topic at the moment.
Yeah, I mean, I guess BP and Eni are the two companies that have sort of led the way with this. Eni with its satellite strategy, and they're doing sort of more and more of this, and we're seeing other companies do more and more of this as well. All the European majors now have at least one strategic venture, and we get asked a lot of questions on this from other companies as well, whether they would be appropriate partners for a major for a strategic venture, or whether they themselves could do it with other companies and things. And I think we've seen quite an evolution of these structures over the last few years as well, going from, I guess, initially it was more about taking a mature portfolio that maybe wasn't winning capital from the group, and giving that a new lease of life, tying it into a growth business, something like that. To the other end, now you've got Eni's agreed a strategic venture with Petronas, which isn't finalised yet, but that's really a really core growth part of Eni's portfolio, but it doesn't sort of have the capital internally to develop that. It's got a lot of growth projects on, partially because it's a very successful explorer, and so it's been looking for solutions to how it can push as many projects on as forward as possible. And one is to bring in a partner who actually does have cash flow that can make that a self-funded business. So Petronas is bringing in some cash-generating assets to develop that. So I do think that kind of illustrates the solution, because what you're looking at here is, we've talked about you're sort of constrained by investors, but you do need to grow in the long term. And there's always been this, oil and gas is a long-term business with sort of short-term investors, but it feels like that's become more extreme over the last few years. So how do you satisfy that? How do you work within those constraints? Maybe it's about different capital structures, which allow you to do more. Maybe it's also kind of operationally as well, as you mentioned, just, focused on higher margin assets is going to deliver you higher cash flow, which you can then, you have more to reinvest and to pay shareholders. So that's got to be part of it as well. One of the reasons why we continually talk about additional exploration is not just to grow the pie entirely, but to find more advantaged resources that can sort of solve some of these problems in a company's portfolio.
I think the other area, Gav, as well, that I'd sort of just add is sort of how companies need to think how they can build sort of areas of unique competitive strength. And this might be focusing on a specific niche if you're a smaller player, or it could be a sort of core part of your portfolio. So this could be, for instance, through the deployment of proprietary technology, the deployment of AI, still at a very early stage, and just sort of new ways of working. And the idea there is sort of you're building up maybe a competitive moat around your core area of operation. And that's sort of quite interesting because it's something that could actually enable M&A activity as well, because if you have this competitive advantage in a specific area, it might be deep water, it might be tight oil E&P, you're able to extract potentially more value from an asset than its existing owner. So that's an area, it's still quite early days with the deployment of AI, but we're starting to see some companies work on that as well.
So, you know, within both of your answers, touched on some key strategic themes for portfolio renewal. They kind of jump out. You know, you've got M&A, exploration, I suppose there's discovered resource opportunities as well. So let's break these down a little bit. M&A, Greg, you talked about, you know, companies looking for high margin opportunities. Everybody wants high margin opportunities. Is now a good time for M&A? Got a very volatile market out there. Valuing companies' assets is never straightforward. It's certainly not straightforward when you have volatile prices. And so I want to sort of throw, you know, the kitchen sink at this. You know, where are the opportunities? What are the most attractive? What are you expecting over the next 12, 24 months in the M&A space?
So yeah, right now it's not a good time for M&A, I would say. I mean, I think, you know, just you can only imagine just now deals which were sort of close to fruition, and you know, you have buyers, sellers, and all their advisors as well, and all these financial models, and all of a sudden oil goes from $60 to $90 to 120 back to 90 again. I mean, you must just be kind of throwing your pen out the window and you know, going to the pub. But I think, you know what. Obviously, right now, and this is what we see usually with volatility, right? You know, volatility happens whether it's down or up. The bid-ask spread opens up, expectations sort of go out of whack a little bit, and then just like we've been discussing here, right? We don't know what's going to happen in the long term. We don't know if this is, you know, net positive or negative for oil prices. And so it takes a little while after that to settle down. And when we've looked, certainly in the past, when it's been price falls, which have been the sort of more common thing, steep price falls, maybe it takes 3 or 4 months after that for things to start really settling again. You know, it will vary. And the fact that we're talking about sort of higher prices is a slightly different issue. But it is, volatility is the problem. So that aside, I mean, I think if you look back at what these companies have done, these 30 companies that we're looking at, M&A has been a huge part of where they've got to. So I was looking earlier, 261 deals during this last 15-year period, 261 deals worth $600 billion between these companies, right? And that's just the sort of direct acquisitions that, you know, these companies were buying other companies which themselves had rolled up through acquisitions during that period as well, right? But 10.5 million barrels a day production they've added on a gross basis. They've obviously sold a lot as well. So it's been a core part of getting these companies to where they are, and it's got to be a core part of where they are going forward. They're not going to fill this gap with exploration and enhanced recovery and things like that, and you wouldn't expect them to. But you know, the question you ask is a valid one, though. But yeah, who do you buy? And that is problematic, right? When we look around at companies that have growth in their portfolio outside of these companies, there's two things, I guess, that are obvious. Who still has a lot of production in the 2040s? It is in the Middle East, you know, the big resource holding NOCs. You want to be doing partnerships with these guys. But from an independence company point of view, there aren't that many. You know, there's a handful of names that probably have growth over the next sort of 5 to 10 years. Most of them in North America, actually, US and Canada, a few elsewhere. But, you know, one of the problems here, to sort of come back to the point that Tom illustrated at the outset, the growth over the last 15 years, about half of it came from tight oil. But we're now looking at tight oil and seeing a sort of rollover in that as well. So actually, our bigger US companies going to have to start looking internationally again. Is there still the growth within the US to deliver there? And then it all comes back, I guess, when you start thinking from that perspective, that you have to have the bottom-up exploration. You have to be opening up new areas, or you have to be getting into places where there's existing resources.
Yeah, I mean, I think just adding to that, given the challenges for the M&A market, companies have to use all the levers available to them. So that's a mix of M&A, it's exploration, and also what we term discovered resource opportunities. So this would be when companies negotiate their way into resources that have already been discovered. So the Middle East would be a good example there, areas like the UAE, Qatar, LNG. But, all of those three levers, I think, are going to be really important for the bigger players to address this longevity challenge, in addition to using more partnerships, deploying more partnerships.
What about exploration then?
Yeah.
Greg dissed exploration just there. He said it's not going to fill the gap. And of course, he's right. But exploration still has a role to play. I think that, from my own conversations with the majors and others, very targeted, high impact exploration. Yeah. And we've seen the success which that can have. Talk about Guyana, I think across that sort of Atlantic margin, there's probably more to come. So what role for exploration in this?
Yeah, I mean, we do absolutely think that there is more to come. And I think maybe going back to what we were talking about at the beginning, that sort of gap and why it's bigger than the gap we saw in 2015. One of the reasons is companies sort of went into survival mode during the pandemic, and exploration was one of the casualties there in terms of sort of portfolio reloading. So companies are having to rebuild exploration portfolios. And I think what's interesting is probably over the last year, we've seen a greater appetite for exploration risks. Haven't really seen budgets creeping up much. Some companies have recalibrated to align themselves more with the average type of spend of the peer group, but not seen budgets that's sort of typically been flat, but certainly sensing that there's been more acreage reloading, but sensing a bigger tolerance for risk when it comes to exploration. So drilling some maybe higher impact exploration wells that maybe have less probability of coming in, but if they come in, they do make a material difference to your long-term outlook. And Greg, you're much better placed to talk about this than me, but again, business models sort of come into the mix on exploration, and E&I is a great example there, isn't it, really, in terms of how they've consistently delivered outperformance in the exploration space.
Yeah, I think so. Because I think when you look at obviously exploration, the more wells you drill, the more success you're going to have. But ultimately, companies can spend a lot of money on exploration and have zero success, while other companies spend money and have great success. And I think one of you can't necessarily control that to an extent, but I think one of the things that companies have to get better at, and one of the things that E&I is very good at actually, is being able to commercialize what you do find. I think if you look down our sort of list of big discoveries, over the last few years, quite a lot of them remain undeveloped. And if you look at what E&I does, it finds something big, it tends to develop it, and that's to do with sort of where it's drilling, the commercial view it has on before it actually drills as well. And it's also to do with the way it structures itself to kind of move forward at pace with as though an exploration well is going to be successful, so that when things happen, they can move forward quickly on it. They also take high equity. They will farm down high equity, what they call the dual exploration model, so that they can monetize quickly and get payback quickly on what they've done. So they have a few things that leads to them. Not just about what they find, but about how they commercialize that leads to them being successful consistently. And you don't really see that. You see companies, like you say, maybe they've had a Guyana or a Namibia or a Mozambique or something like that, but they're quite spiky if you look over a sort of 15-year performance. But E&I is kind of consistently successful, and that's one of the reasons why.
I think the other point on exploration as well is probably a greater appetite for high-risk exploration, but it's also got an important role to play in sustaining legacy businesses. So some of these mature areas, Norway, a good example, where incremental exploration can be very lucrative. You're tying back a discovery to an existing hub, typically sort of very quick turnaround, quick lead time. They generate very good returns, and you just maintaining that production. So it's not just about elephant hunting. There's also quite an important component to sustaining the legacy portfolio.
Great.
And I mean, obviously, I was just going to say, in that, governments have a role to play there. Obviously, in more mature areas, the fiscal terms, the fiscal systems that encourage companies to continue investing and to continue maintaining their portfolio, rather than just to say, we're sort of out of here, we're going somewhere else. We can't get the capital returns we need here anymore.
Yeah, and I see that quite a lot in some of the frontier areas in West Africa, for example, where we might see the majors looking to bilaterally negotiate terms and take large swathes of acreage and commit to drilling on that. And I knew once we got onto exploration, it would fire up. Always the way. Just aware of time, we've got some great questions from the audience, which I want to jump into. And so one question, which is actually about three questions, something which we probably all learned from the way that journalists ask questions at White House press conferences. You never just ask one, you just fire 3 or 4 off. Member of the audience looking to understand what needs to happen to the CapEx plans of the 30 companies you've covered over the balance of this decade to help find that additional 22 million barrels a day.
Yeah, well, I mean, I think in terms of sort of the CapEx spend, we're probably not going to see a big departure from the existing business model, which is 30 to 50% of the operating cash flow will flow back to shareholders in the form of dividends and buybacks. So that does impact how much companies can invest. And what does that mean? Well, they're going to have to get more efficient, which is, we've touched upon that a little bit, I think, during the call. And they're also going to have to think about sort of new business models, partnerships, etc., to help address that gap. Maybe we do see a bit of a shift back towards growth, growth being favoured by the investor community, which might mean oil and gas companies get the green light to allocate more capital to investment. Not really seeing that at the moment. Still a big focus on capital discipline and shareholder returns. But if oil and gas companies can demonstrate they can deliver good returns from their investment, there's a possibility that there might be a bit of a shift back towards growth investment. But I think, Greg, I mean, would you agree it's probably unlikely? It's not going to be a big shift if it does happen.
Yeah, I mean, I have to say, I was surprised at how long capital discipline has persisted, because I sort of felt when this first started appearing that we'd get a price uptick at some point and everything would just get thrown to the wall and people would just start drilling out, particularly in North America. But capital discipline has persisted now for many years. Actually, it's hard to see us going back to the days of, in fact, it's impossible, I would say, to see us going back to the days of 2015, 16, when companies were leveraged up to the hilt to grow. So I think whether taking the brakes off capital discipline to an extent towards growth, yeah, maybe, Tom, but not like it was. I would say not anything like it was. I think one thing to highlight as well is obviously our production gap. We're modelling here based on $65 a barrel long term, and if that price substantially changes, then obviously if it goes up, if it's higher, you do have more money, even if you're paying 50%, even if you're paying out 50%, the 50% you retain is a higher number to reinvest in the business. So you will get more growth. So prices have a huge impact on what the ultimate investment number is and the growth number is.
I know there are other ways you can address the challenge as well. So one of the trends we've seen in recent years is companies talking more about net capex rather than their organic capex. And what does this mean? Well, it's typically the companies that have higher reinvestment rates, and they manage that through asset sales. So you're seeing sort of portfolio churn, if you like. They're selling non-core assets, maybe they're sort of the lower margin assets, and redeploying that capital into growth. Typically, that's higher margin growth. And I think for some of the companies that we cover, that's been a very successful strategy. So, there are a number of different business models that we've seen implemented in recent years that can help address this challenge.
Yeah, because I would say that gets back to, again, the fundamental question is, how do you give investors what they want and also deliver for the long term? And investors seem to be okay with this. If you're going to churn some old assets, spend more cash, that's okay. We're not just strictly looking at, say, operating cash flow going into. If you can do some divestments to balance that, we're sort of okay with that. So yeah, it's about working out how to, like I said earlier, work out appropriate structures that allow you to do both.
So look, there's another question here, which probably exactly the same theme, but diving in a little bit more on a specific geography, and you won't be surprised, it's lower 48. So within that context of what you've just been discussing, so price, capital discipline, longevity, what is the outlook for lower 48 production? Investment, rather, maybe investment first.
Well, I guess a couple of things. One of the things is that we do have a view that lower 48 production does sort of roll over into the next decade because you're sort of drilling through more of the tier 1 acreage. And what you find is that there's a question: can operators make tier 2 acreage into tier 1 acreage through sort of innovation? What you find when you look at the portfolios of companies in the US is that the biggest and best companies tend to have the biggest and best tier 1 acreage, right? And so you're probably going to have a collection of kind of smaller companies who are going to struggle because they're going to burn through their inventory more quickly. But if anybody can turn sort of tier 2 acreage into tier 1 acreage, it's probably going to be the larger companies. And one of the things that we've seen from M&A over the last couple of years, I think ExxonMobil is a great example. When it bought Pioneer, which was already one of the top operators, said it was going to get a couple of $1 billion of synergies. I think, Tom, correct me, but it's up to about $4 billion, I think now, right? And these are kind of operational synergies, right? This isn't just sort of cutting G&A costs, but actually on the ground operational synergies to do with well performance and things. And part of this is just, and Tom, you're probably a better place to explain this, but just Exxon's kind of vast data library and experience, and also proprietary technology it has, including its proppant and things like that, which is allowing sort of better well performance. I'll let you cut in on that, but I would just say that the bigger picture of M&A in North America in unconventionals over the last few years has been about delivering. It has delivered operational efficiencies, right? That's been the case for a number of years in the US. It's not as easy to do this outside North America, where you have conventional assets that are effectively kind of separate. In the US, because you have maybe checkerboard acreage, and if you can combine with a company nearby, you can develop that more efficiently. You can drill longer laterals. You can put in more efficient development plans. You put in more efficient infrastructure across it. Being bigger is better, right? And that's one of the sort of two reasons it's been driving sort of scale in the US. One is having a diverse sort of platform base where you can return more capital to shareholders and be immune to more shocks. And the other is just being a more efficient operator.
Yeah, the only thing I would add, I think that's a great explanation, Greg, is that just sort of zooming in on Exxon with their development plans. They're expecting the wells that they drill this decade to deliver a break-even of $30 a barrel at a 10% discount rate. And, that is sort of very much best in class. And what does that mean? Well, that flows through to investment. So they're continuing to invest for growth. They've got guidance for very strong growth out to 2030, which they think they can continue into the 2030s. So, if you can improve the efficiency, well cost, the break-evens, it can open up a lot of new opportunities, both in your existing portfolio, but also with respect to M&A. And I think we're likely to see more examples of this from the bigger names in the lower 48.
And so I think, in summary, I think what we expect from the US is more consolidation. Companies continuing to look for scale. There is a question as you move into the 2030s, if you are truly sort of getting through more tier 1 acreage, do we then start to see companies moving abroad? And we've already seen a few companies dipping their toes, whether it's in the Vaca Muerta in Argentina, or whether it's and sort of other sort of shale or tight plays around the world. We are seeing companies that dip their toes in, so that is a possibility as we sort of move through the years.
Okay, let me continue this theme, but ask it from a different perspective, because there's two audience questions here which are broadly similar. I think are asking the same question, and it's generally, we've got this supply shortfall. Will it be the NOCs who fill this? And another question, what it means for OPEC. So we talked about these challenges for the 30 companies to try and maintain capital discipline, find the high margin opportunities. We're not talking about a resource challenge when we look at this holistically. So do you see big OPEC producers filling that gap? Is it other NOCs who take advantage of the supply shortfall?
Absolutely. From a sort of, if we take a step back and look at the overall macro picture out to 2050, we think that the world has enough supply to meet demand. The question is sort of which companies are going to be producing that. And the Middle East is going to be, for understandable reasons, absolutely a core area, given the scale of the resource, very, very advantaged resource. And, that's why until recent events, we have seen some of these bigger names step up their business development activity in the Middle East. And, it does all sort of fall back to this next decade longevity challenge in the oil and gas sector. And, if you're going to address that, I think you do, if you're a big player, you need to have a material position in the region. Now, clearly there's a lot of uncertainty at the moment, but at the end of the day, it's where those very advantaged oil and to a degree and the gas resources are located.
I think
Sorry, Greg, go ahead.
I was just going to say, if you flip that, I guess one question you could ask is, if the guys in the Middle East have this resource, why would they give it up effectively? Why would they let these companies gain market share? And I suppose one answer to that would be, you look at Aramco and ADNOC over the last couple of years have been trying to build big gas businesses. So, can you do a partnership with these companies? They want to build gas businesses for diversification purposes. You only have to look at what's happened, over the last couple of weeks with Qatar Energy, and its reliance on LNG. The diversification in your business, obviously from a climate perspective, being big oil producers, you can see why you would want to get into gas. Maybe there's reasons if you're in gas actually to have some more oil as well. So yeah, I think these companies, we have seen them partnership. We've seen them partnering with some of the big IOCs, and it makes sense for both parties. I guess the question for these companies in the top 30 or the 30 that we have is, what can you offer these other companies that have that longevity in order for them to I guess share that with you? What have you got to give to them?
Yeah, and I think gas LNG has proven to be a pathway to do that. We've seen that with XRG, Mid-Ocean, etc. Vehicles to internationalize the gas businesses of some of those Middle Eastern NOCs. we're running out of time. I knew this would happen, so we're going to have to get a bit faster in our answers. Audience question: climate goals and climate goal deadlines getting closer. How does repivoting back to oil and gas, upstream oil and gas, by these companies, or by Western economies, actually, is the question, impact their climate goals? It's a really interesting question, particularly given the context.
Yeah, I mean, from the sort of company perspective, the companies are still very focused on reducing their scope 1 and 2 emissions. So these are the direct emissions from their oil and gas assets. The challenge is really the scope 3 emissions, the end user emissions. And in order to reduce that, you've really got to be reducing your oil and gas production. So some of the production profiles that we see with these big declines, they are aligned with those climate goals. But if companies do decide that they want to sustain their oil and gas production next decade, then it's very difficult to see how you can reduce your absolute scope 3 emissions. So still very focused, oil and gas companies are still very focused on reducing their direct emissions. But if they are going to recalibrate towards oil and gas next decade, which looks like it's going to be the case, that does have implications for some of the guidance that we've seen on scope 3 emissions reduction.
I think it's fair to say as well, though, that even on scope 1 and scope 2, some of the interim targets have been loosened and pushed back, right, which is just a natural consequence of changing portfolios. I mean, it's probably worth highlighting as well. Again, overall, we're looking in the context of market share within where we think demand is going to be. So if these companies are effectively, taking market share from other companies, the overall emissions that the industry produces is kind of unchanged by that, and it's really a question of long-term demand that kind of drives that.
Brilliant. There are more questions, but if we get into them, we're going to be here for hours to come. So I'm going to call time on this at this point. We're almost 50 minutes. First of all, to the audience, thank you very much for joining us. I've really enjoyed the discussion, and thanks to Tom and Greg for that. We began this horizon thinking about what these 30 companies need to do to renew their portfolios. I think it's become more urgent, it's become more challenging, and potentially throws up some opportunities, given the current conflict in the Middle East. And it's really brought the discussion into focus. So before I wrap up, I'd just like to remind you that you can read all our Horizons Thought Leadership pieces and sign up for our weekly insights at woodmac.com/horizons. And please keep an eye on LinkedIn for all details of our upcoming Horizon Live events. This has been a WoodMac production. Thank you for joining us, and we look forward to seeing you next time.